Good morning, everybody. Welcome to today's Workshop Wednesday webinar. Let's talk yield. My name is Jacob Wilson. I'll be facilitating today's discussion. I'm a business support manager here at First National Bank Alaska. Today, Senior Vice President and Wealth Management Director Morgan Neff will share his expertise on current market trends and how a long-term yield strategy could help you realize your financial goals. Good morning, Morgan. Can you hear me okay?
Good morning. Yeah. Can you hear me?
I can, loud and clear. Thank you.
Fantastic.
Before we begin today's discussion, Morgan, would you please give us a brief overview of your background and how you earned your expertise in the financial industry, including your position here at First National?
You bet. First, I'm going to start off with some boring stuff. I'm going to tell you that the products purchased through the bank's wealth management department are not FDIC insured, not guaranteed, and may lose value. So that's our little one sentence disclosure I have to get through. But yeah, so prior to my role with Fnba, I spent 20 years as a lead decision maker for multi-billion-dollar investment organizations. And during that time, one of my largest focus for my investors was the fixed income space. And during that time, I was very fortunate. I was able to produce a track record that was recognized by leading publications, including Nelson's, Lipper, and Pensions and Investments as one of the world's best money managers over a 1, 3, 5, and 10-year period. So fixed income has something that I know very well. It's near dear to my heart, and I'm actually very excited to talk about it today. My role within at First National Bank Alaska Wealth Management and Trust is not too dissimilar from how I started my career, where I started out on the wealth management side and grew it into a multi-billion-dollar wealth management and institutional manager space. Here, no different, strong relationships with clients, focusing on the needs that they want to set up strategies to hit their long-term goals, so that that they can meet retirement or other fundings that they need in the future. So very fortunate to be sitting in the seat that I'm in with the wonderful team here at the Wealth Management and Trust Department, and look forward to eventually having every one of them on one of these calls in the future. Before I get into the slide, I want to tell you how much I appreciate for every single one of you joining today's Workshop Wednesday webinar series, especially with how beautiful the weather is today. I don't know about you, but I know I didn't really expect to see a summer this year after what we've gone through over the last couple of months. Interesting enough, our late summer is somewhat analogous to our conversation today, which is talking about yield. Now, I know what you're thinking. This is going to be a stretch, man. Comparing the current state and trends of the fixed income market, there's no way it can hold a candle to this glorious Alaska summer that we're now experiencing. Well, possibly, but at least I hope after our short time together today, you take and develop a deeper appreciation for the topic. So let's jump in.
Morgan, before we jump into the presentation here, I just want to give a quick reminder to all of our guests. There is a question and answer feature at the bottom of this Zoom webinar, and I do encourage you to use that. We're going to try to make this presentation as dynamic as possible. And so feel free to ask your questions throughout the presentation, and I'll jump in and ask Morgan. And then we'll also reserve time at the end to ask Morgan any questions on the topic as a whole or anything else you want to pick his brain about. So with that, Morgan, maybe jump in.
That's a good point. Like anything that comes in on the fly, feel free to interrupt me. I mean, I want this to be dynamic. I want this to be fluid. I want whoever's on this call to get the most out of it. So we're going to kick this off with a little refresher on the fixed income class. It always amazes me when I have conversations with clients about fixed income, and they self-admittedly tell me that they know a lot more about the equity space and a lot less about the fixed income market. Many are actually shocked when I tell them that the global fixed income market is larger than the global equity market. And as you can see in this data point below, the global fixed income market was almost 130 trillion at the end of 2022 versus 120 trillion for the global equity market. Now, the US does make up approximately 39% of both of those markets. But it is something that I'm always amazed about because fixed income does play such a vital role, and it's commonly invested through investments known as bonds. One of the things that I get asked about is why do you think, I know, Jacob, you were asking me this questions. Why do you think clients feel more comfortable about their understanding of equities than they do fixed incomes? And I think it has a lot to do with many things. One, the market for individual bonds trade over the counter, which that means they're not listed on a major exchange. Instead, they trade through a broker dealer network. This is why most investors get their exposure to fixed income through mutual funds and exchange traded funds, which offer great access, liquidity, and diversification to fixed income asset class. The other is access to information on the market is not as pronounced as the equity market. I mean, I don't know about you, but I'm not turning on CNBC or Bloomberg TV and hearing them engage in just a very in-depth conversation on why, company XYZ's bonds have increased in value or the spreads have widened 50 basis points over the last week. Equities at the end of the day represent ownership in a company, and that means something to people, and they can actually understand that. Well, if I own a piece or a share of the company, I own a piece of the company, and I've got a vested interest. Versus bond investors, they're lenders, and it's probably at the end of the day just not as fun to talk about on TV, and it's not as interesting at the end of the day. But it is a massive driving force in the markets. So let's talk a little bit about where you might see some of these investments and what are some of the common types of bonds that you might invest in through mutual funds, ETFs, exchange traded funds, or individual bonds. Government. This is specifically U.S. government bonds, which are generally referred as the safest in the fixed income space because it's used as a benchmark for pricing of any other bonds, corporate bonds, any other bonds, because of the incremental credit risk that's involved. In fact, the 3-month treasury is often referred to as the risk-free rate of return.
Hey, Morgan, can I jump in really quick?
Yep.
You had mentioned that actually in a couple other times that we spoke, a risk-free rate of return. And I didn't think that there's really an investment asset that was risk-free. So could you maybe explain that a little bit more?
Yeah, no, it's a good question because, the first thing you learn when you get into the investment space is you can't tell clients it's risk-free and you can't guarantee returns, right? And here I'm talking about the risk-free rate of return. The reason why it's the proxy, it's used as the proxy for a risk-free rate of return because the market considers there to be virtually no chance that the government, the U.S. government, would default on its obligation during those next 3 months. And keep in mind, it's constantly rolling. So you get this risk-free rate of return, which is offering a very unique opportunity that we'll discuss a little bit later, but it's also what all investment managers look at as the proxy to other asset classes and whether or not the risk in other asset classes justify the return that they're giving versus that risk-free rate of return. So, Jacob, I appreciate you bringing that up. Corporate bonds. These are bonds issued by companies to raise money for business purposes. As stated above, they typically pay higher rates than the government because they do tend to have some level of credit risk. Emerging market bonds. These are referring to bonds issued by companies in developing markets such as Latin America, Russia, Middle East, and Asia, excluding Japan. They've got a different level of risk, not only currency, but also credit risk as well. Then you've got inflation-linked bonds, or what many of you probably know as TIPS, Treasury Inflation Protected Securities. These are Treasury securities that are issued by the United States government where the principal amount is adjusted for inflation. These have been something that have been, very hot and have had a lot of money flow into them over, the last 24 months and have worked as they were designed. And then lastly, and not comprehensively though, you've got mortgage-backed and asset securities. These are bonds of individual mortgages or other asset-backed loans, which are then bundled into a single bond, which allows investors to receive the economic benefits, such as the interest and principal payments associated with the underlying mortgage payments or the loans that are backed by the assets. So last on the refresher, let's just talk a little bit about some of the bond terms and key characteristics that you've have either heard me talk about today or you'll continue to hear me refer to. So maturity, this is the time when the bond issuer must repay the original bond value to the bondholder. And the risk-free rate, that's 3 months, 3-month maturity. Coupon, that's the annual interest rate paid on a bond expressed as a percentage of the face value and paid from the issue date to maturity. That's your interest payment. Most corporate bonds will pay semi-annually, and that is where you get your predictability. That's where you get your stability. That's what is the difference between fixed income and equities, is that coupon or interest payment. Price, most all bonds are priced at issue at par, but because of some of the things we'll be talking about a little bit later, you'll see movement in prices. Prices will go up, prices will go down, and where you buy the bond at will ultimately drive what your interest or your coupon return will be, because those two are very much related, which is what current yield is. That measures the expected annual return of a bond, and it's calculated by dividing the annual coupon by the current price. So if your coupon is 5% and it was issued at 100 cents on the dollar, and you end up buying it cheaper at 95 cents, your current yield is going to be higher than your coupon rate because you're getting a discount on the bond versus the fixed coupon that it was issued with. And then the last two, yield to maturity, is the calculation based on the coupon rate and the length of time to maturity, as well as the market price. And then yield to worst is the calculation of the lowest possible yield that could be received by a bond in the event that the bond has an early redemption feature, such as a callable bond. And then what we're going to get into a little bit in deeper is duration. And while duration sounds like it's very much associated with maturity, it is expressed in years, but it measures a bond's sensitivity to rises and falls in interest rates.
Morgan, I'm going to jump in really quick. That's all right.
Yeah.
So I had a question that actually you and I had discussed, and we were maybe going to talk about it later, but I want to use it as an opportunity to encourage everyone to go ahead and ask their questions as it's come up. And this is the first question, so I wanted to get it out there. What effect will the recent Fitch downgrade have on the bond market? So,
great question. It actually hasn't had any effect. If you've been on a call with me over the last several months, prior to the United States lifting the debt ceiling, the topic of the day was, is the U.S. going to default on its debt? Because that's what it was heading towards, because it was going to be a technical default, because the United States and the both sides of the aisle were politically jockeying one another for demands while not raising the debt ceiling. I continuously said that there was probably a very little chance that the United States would actually default, but that there was a very high likelihood that the United States credit rating would be downgraded. And I had the same question at the time, and I said, well, ratings are lagging indicators, and the yield is already forecasting that there's going to be a downgrade. And sure enough, with the Fitch news coming out today, that's exactly what has happened, is that there really hasn't been a movement in yield, and that the yield has already represented whatever the market was anticipating, which at the very least was a rating downgrade. This happens across the board. If it's an investment grade corporate bond and their financials are deteriorating where it looks like it's going to get downgraded a notch or two, the yield of that corporate bond will reflect the potential downgrade long before the actual downgrade occurs. So that just goes to show you the efficiency of the fixed income market at times. But I don't know who asked that question, but it's a great question, and it was widely expected by us, and as well as many other most of the other market as well.
Thank you, Morgan. I appreciate that.
No problem.
Please keep those questions coming.
Yeah, slide 5 is just very, it's a graphic to show you that the inverse relationship between price and yield. And it's to show you exactly what I was talking about earlier. If prices go down on a bond, that means your yields are going to go up. If yields are going to go down, that means your prices are going to go up. Now, where you have to take this all in consideration and why these two matter is when you start factoring in duration. And this is an example. This is not a real example. This is just something that I made up to show you why duration is a measurement of interest rate sensitivity rather than maturity. So take the two examples here. You've got, bond A and bond B. Let's go bond A, for example. The maturity, 5 years. Remember, maturity is when they have to pay you off. They're paying you a 5% coupon and the yield on it is 5%, right? So that means that you bought it at face value or par. Now the duration is 4.55 years. So what that's telling you now is that if interest rates were to rise by 1%, the price of that bond would go down 4.55%, directly correlated to what the duration is indicating at 4.55 years. Conversely, if interest rates were to fall by 1%, that bond price would go up 4.55%. Same thing with bond B, very similar, where you're seeing the duration match its sensitivity to ultimate interest rates. And so we've had a lot of discussions over this over the last several months about duration risk and why we continue to believe, focusing on the shorter end of the market is the more appropriate place to be for the time being, because one of the return profile, but also because of the duration risk right now is too great, and it's starting to improve, and we'll go into a little bit more of that a little bit later. But I think duration, because fixed income was such at low levels for such a long time, a lot of investors were really stretching their investments in fixed income by taking on additional risk through duration. And unfortunately, that has really impacted a lot of portfolios.
Morgan?
Yep.
Is there any way that you could maybe point to a real world or current example of this relationship for the yield, price, and duration that you're discussing?
No, absolutely. So, a great example is going to be what has happened over the last 3 or 4 months with Silicon Valley Bank. Here it was a bank, several $100 billion-dollar bank, excuse me, and their investment portfolio, very high quality from a rating perspective, but very long from a duration perspective. And when I say long, their average maturity was greater than 10 years, and then their duration was just around 10 years. And so when interest rates started going up and we went from 0% interest rate, Fed funds rate essentially to, 3 or 4% Fed funds rate, in the early part of this year, that was a massive move for their portfolio. Because remember, 10 years duration on that portfolio. So multiply 10 by every 1% move in rates that has occurred since at the beginning of the year, or since the Fed started raising rates. So let's just take 3, for example, 1% increases in rates. So that means 3 times 10, that's 30 points that the bank ended up having to look at their portfolio being priced at on a very high quality portfolio. So you saw 30 points of degradation, of market price degradation, because duration played such an important factor in the rising rates. And it was primarily the largest contributor to what eventually ended up, making that bank insolvent. So that's the most recent and probably most applicable Example of how duration comes into play, even if you have a very high quality rated portfolio. If you're very long and rates start to rise and you're locked in, you are still very much susceptible to volatility. Did that answer the question, Jake?
Yes, I appreciate it. Yeah.
Great. So we're gonna get fun time with graphs. One, because it's colorful, and two, these tend to make us look a lot smarter than we are at times. This graph is a great visual of both an inverted yield curve and a normal yield curve. What is an inverted yield curve? This is when interest rates on long-term bonds fall lower than those of short-term bonds. The reason why we're going through this inversion is on the treasury curve is that the market is indicating that the rapid series of rises in interest rates by the Federal Reserve could cause a very sharp or hard economic slowdown, hard landing, as they call it. And that curve, as you can see on the screen, is indicated by the green line. A normal yield curve, which is the amber or mustard color below, it's typically upward sloping, and it means that the longer the maturity, the higher the return. And what it tells you is that a longer bond usually will involve more risk, that the borrower will default or interest rates will change or some other scenario. And so therefore investors demand a higher return for the length that they're taking in their investment. And I'm going to try to go up here with my little pointer here. Let me find that, Jacob. There we go. So this is the market we're in. When we're talking about risk-free rate of return, I mean, we're talking here, 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 and really here. This is all less than 365 days. And as you can see, when we're talking about you're not getting rewarded to take duration risk, anything after a year right now falls off pretty precipitously, right? And then you can see all the way out here where the 30-year is at. All right. So at this point, because the yield curve is inverted, it's giving investors an incredible opportunity to take advantage of very strong yields on a relative and absolute basis without a lot of risk. I mean, very little credit risk from the United States government, I'd say none, and then virtually no duration risk. And that's unique. Most of the time, inverted yield curves last for just under 10 months. Technically, this yield curve started back in March of 2022, so we're 16 months into it. The longest inverted yield curve lasted 21 months back in 1978. Now, the one thing this does, and it has always shown that we've been a predictor of, is that that we're going to be in a recession, in the next 15, 18 months once it starts to invert. It's never not predicted a recession, and I'll show you a chart going into the next slide. And like I said, it takes about 15 months on average for the economy to enter a recession. But we should be thinking that that's inevitable in a way anyways, because the Fed is trying to slow down the economy to combat this persistent inflation issue. So they're wanting the economy to slow down. Now it's all about interpretation. Is it going to be a hard landing or a soft landing? And you've got arguments for both. The softer the landing, the smoother the transition will be to a normal yield curve. The harder the landing, the more volatility that will be created, which also includes more opportunity at times. But eventually you get to the same result, which is a normalized yield curve where the Fed starts to try to increase economic activity by cutting rates.
Morgan, we have another question from the audience here. Just wanted to jump in. So what you're saying essentially is that, I mean, when would we not purchase a longer term bond at this point, or would there be any reason to purchase a longer term bond?
Well, everyone's different. And I'm looking at the best, when I'm talking about return for the given amount of risk, purchasing longer bonds right now, I don't, if it's the 10-year or if it's even the 7-year, you're not getting the yield that you are getting right now for something taking less than a year of duration risk. And so if you're wanting to lock in, 4% rates or 4% rates over 7 years, that's great. Just understand that it's going to be a lot more sensitive to any additional, interest rate moves up or down. So if the Fed starts cutting rates, that could perform relatively well. If Fed stop cutting rates, but interest rates remain high because we continue to see that the economy is and the market is requiring a higher rate of return, then you're not going to see the relative value that you would see by investing in this and continuing to roll it. Again, this is short term. Like I said, this inverted yield curve on average the last 10 months, we're 15, 16 months into this one. And the Fed has been very active on raising rates. And we're starting to see those actions impact the economy in a manner that they want to. So, in the meantime, we're strongly encouraging clients to at least focus on the front part, just because this doesn't always exist there. As you can see, a normal yield curve back 5 years ago, the 3-month was at 2%. I mean, on my next slide, you'll see the 3-month 24 months ago was at 0.4%. So there's been a massive shift. There's been a massive move in the yields on this front end. And it's an opportunity, and that's really what we're trying to get across on this particular slide.
Thank you, Morgan. I think that answers it. Appreciate it.
Yeah, I'm trying to get back to where I can. Yep. All right. So what we're going to show you is the last 30 years of the Fed funds rate, which is basically what the Fed is using as their benchmark rate, and the 3-month Treasury. As you can see, they are as correlated as you can get. And the last time we saw anything, like what we're seeing now was right before the financial crisis of, the Great Financial Recession, right? And then before that was right before the recession and the bust of the internet bubble right here. Which is kind of interesting because if you look at the next slide, those periods followed recessions. So you had a recession that followed this period. You had, the Great Recession, right? And then you had a recession that kicked up during COVID. Now, that's an interesting one to me because this is why the Fed has been so active. They printed, over $7 trillion of new money to prop up the economy. To me, it defines itself a little bit when you see that much economic activity crater. It's more than a recession at that point. But we ended up propping up, a lot of the economy, a lot of businesses with the amount of stimulus that was pumped into the economy, which there's no free lunch, and that's why the Fed is out there actively raising rates to get inflation under control. And so how has this affected the rest of the market? So this is the yield to worst on the aggregate, which is a combination of government bonds, investment grade agencies. It's essentially the benchmark to the high quality fixed income investing that you see most investors, have an allocations to. And again, we're getting to a point where at 4.8% yield to worst, it's looking like it did back, right after the financial crisis, and definitely not as high yet as back leading into the 2000-2001 recession. But we're starting to see yields that really are making a lot of sense, that are getting us excited about the fixed income class as a whole, not just the short part. Here's the investment grade yield to worst, a little higher. Again, more credit risk associated with this asset class. And as you can see in 2008, you saw yields really spike, come really back down, and then they've been fairly low and anemic during this 10-year period and starting to pick back up. The next makes it a little bit messy, but this is the high yield space. These are companies that are smaller, but have the lowest ratings, within corporate finance, double or triple B or lower. And this is one where you see most of the defaults or credit, issues happen because they're smaller, they have less access, less liquidity. And while it looks like it's lower, it just, because the spreads have widened out so much in this period to 22%, you're starting to see high yield now back to 8.4%, which is an interesting level because of this slide. So after 13 years of anemic levels in the fixed income space, it now appears that fixed income across the board is heading back to its historical average yields, right? And what I mean by that is just look at what's happened over the last 24 months, right? June 30th, 2021, the 3-month T-bill, the risk-free rate of return, was at 0.4%, 5.42% at the end of this quarter, 6/30. Ag 1.5, 4. Significant expansion. You're talking 320% increase, 268% increase. These are basis points increasing. 100 basis points equals 1%. So 3.31%, 3.4%, 4.76% in yields. Now you go back and you look at what these yields were on a historical basis over 30 years, and look, we're now starting to get to levels that are commensurate with the historical average, which is very promising because we're not seeing yields widen because of a tremendous amount of balance sheet or financial deterioration. We're seeing it because it's reflecting the macro on the interest rate level. The Fed is rising rates, therefore everything associated that has a higher credit risk to the United States government is going to be appropriately repriced, and that is what we're seeing today. And not only are we seeing that today, in yields, but we are also seeing that in just investors returning to the market. In 2022, the taxable fixed income space experienced its worst outflow in 22 years. $216 billion left that space. However, we're seeing a reversion of that this year, and year to date, investors have poured back $140 billion back in the taxable fixed income space. And it's because of that return to yield. It's because they are starting to see that there's a place for fixed income again, back into a proper allocation mix, a proper balanced portfolio construction. And I'm expecting that momentum to continue because I expect yields on the fixed income side of the asset allocation construction to remain fairly and robustly high. I don't believe we're going to be seeing the 0% or near 0% rates that we have been experiencing over the last 10 years, unless there is some major economic situation where the Fed would have to cut all the way back down to zero again, and then you would see those rates follow in tandem. So again, I really can't tell you how much I appreciate the time today. I know that if you're not a client of ours, I want you to be a client of ours. I'm going to try to make you a client of ours if you're not a client of ours. But if you're not, all I can do is urge you, have a conversation with your broker, have a conversation with your advisor about the role fixed income can play in your portfolio today. Everyone's different. Every situation has different needs, but the vacancy that fixed income has been in client portfolios for the last 10 years is something that has driven some sort of complacency. Don't be afraid to re-engage in that conversation. If they don't want to have that conversation with you, you pick up the phone, you call me, I'll have that conversation with you. So, Jacob, I'd like to turn it back over to you, see if we got any other questions or any kind of follow-up.
Yeah, absolutely. And actually, our first question is going to take you back 2-3 slides here to the graph on page 12. And the question is, why did we see such sustained low yields from that 2008 range, really all the way to 2022? What were some of the underlying factors there? I think is the gist of this question.
No, it's all about the relationship to where interest rates were as a whole. So after, remember the great financial crisis, there was a lot going on, massive amounts of toxic debt and leverage in the system. And we're still, as an economy, still unwinding a lot of that today. And so in order for the Fed to re-stimulate the economy from something that was what the closest we've come to a depression, they cut rates dramatically and had to leave them there. As you can see, the Fed funds rate in the 3 months for an extended period of time. And as you can see, this is all the asset classes are going to be based relative to the return you would be getting off of the 3-month treasury or the government, bond space. And we started to see, rates start to pick back up. And then we ended up going through the pandemic, which then created another capitulation in the Fed funds, having to bring it all the way back down to zero, at the same time pumping $7 trillion into the economy, which was kind of a double-edged sword. And then now you're starting to see yields ink back up. And that's what we want to see. We want to start seeing these yields really offer something that makes sense for investors, because it was very difficult. I mean, I love fixed income and I've been doing it a long time. Very difficult to talk about fixed income during this whole time period right here, and it's just because it didn't look great, and you were running in front of a multi-bull period for equities. And so you bring up fixed income, you look like you were, wearing the dunce hat, as a little kid in school. You didn't, people thought you were crazy. And to a certain point, it was very hard to justify. But now we're starting to get to levels that it makes a lot of sense. And again, I encourage you, if you don't have an exposure to it, or you've got small exposure to it, or if you want more exposure to it, have those conversations.
Thank you. Appreciate it. Before I get into these next two questions, I think I'm going to combine into one. I do want to encourage everyone to, this is an opportunity to pick Morgan's brain. So please ask away anything you've thought of or anything about this presentation. Jump on in and use that question and answer feature. So Morgan, you've laid out a picture of the bond market and presented a lot of data today. What can we infer about the bond market throughout the rest of this year and 2024? And then I'm going to pair that with, are you saying that a fixed income strategy would offer better protection and potentially higher yields in case of a recession in 2024?
So your first question is what are we seeing going into the end of 2023 into 2024?
Essentially predictions.
Yeah. So one thing I have never done and will never do is to try to predict what the Fed is going to do, because quite frankly, they're dealing with a very fluid and dynamic set of values that they're having to make decisions on, and trying to predict that to any level of certainty can be futile. What I do know is that you're starting to see their actions be indicative of the outcome that they wanted by their actions. You're starting to see inflation come under control, and I believe it could make sense for the Fed to come start looking at some pauses here and to see really how this is going to play out with what they've done. But that doesn't mean they don't raise it another 25 or 50 basis points just to drive the nail home. I think that they're really kind of worried about stagflation, and not that there's a chance of it happening, that they just want to make sure they're staying in front of it. And stagflation is when you have inflation but no growth. And there's a lot of very bad economic scenarios that follow stagflation. Stagflation was one of the major drivers of the Great Depression. And the only thing that brought the Great Depression out was World War II. So, that's just been an academic study for every Fed chairman since the Great Depression, is making sure you're steering clear away from those scenarios that would produce that result. The next question is whether or not fixed income, is a way to allocate fixed income into your portfolio to handle different types of economic situations. And I would say absolutely. So fixed income and equities generally behave very differently. 2022 was somewhat of an anomaly year where you had fixed income and the equity market both, experience double-digit, negative performance. And it was because of how swift and fast the Fed started rising rates, the fastest in history. Very uncommon, but yes, fixed income has typically done very well and held up very well during periods of recession, because remember, fixed income investors, as a lender, you don't need to have the company grow. You don't need to have the company, expand margins like you would if you're an equity investor. You need them to be able to generate cash flow needed to service the debt and to either pay you off or to refinance you at maturity. So they're very different dynamics as far as what you're looking at from the company. You obviously want what's best for the company, but you don't need to have that in the fixed income space. I believe that, the higher that these yields get in the fixed income space will present itself even as a better opportunity to dampen volatility if there is a deeper recession than expected. And so that's why we're encouraging, clients and investors to really start thinking about it as part of their allocation mix.
Thank you. And that actually, I think, ties right into this next question, which you kind of answered, but I'm still going to ask. My understanding is investing in bonds won't give me as high of returns as equities. So why should I invest in them, or should I invest in them?
Well, it's not about, I think there's a misunderstanding of higher returns. And not to get academic here, but yes, you could absolutely invest in a lot of things that have higher returns. But when you start looking at the risk associated with the asset class or the investment, is it higher on a risk-adjusted basis? I will tell you that fixed income has routinely outperformed equities on equity returns on a risk-adjusted basis because of the lower and dampened volatility, and during periods where you've got economic contraction, they hold up very well. And so there have been long extended periods where, while it doesn't look like the absolute return, as a percentage basis, that they outperformed, when you factor in the volatility, the ups and downs and the highs and the lows between the asset class, it absolutely has generated a better return from a risk-adjusted standpoint. But depending on your situation, and especially now, again, it's so much different of a conversation than we would be having, 2 years ago. It provides an opportunity for you to, basically barbell your portfolio, where you've got your equities and then you've got a great predictable rate of return in fixed income that's giving you, your cash flow stream and the protection that it has as being a bond, as a contractual obligation from the borrower to you as the lender. And so because of the yields expanding now and where equities have now traded, I think they offer a very compelling combination, because equities earnings growth right now is approximately 5.4%. This is the first time I've ever seen equities earnings growth be lower than what the 3-month treasury is at this point. So I wouldn't recommend a blanket allocation for everyone. I'm just saying every situation is different, and that this is a time to start looking at the asset class and to see if it makes sense for you and your long-term needs.
Well, Morgan, that was our last audience question. Thank you, everyone who did submit those questions. Morgan, if somebody does have additional questions on fixed income asset classes or anything else, how'd be the best way for them to reach out to you or your team?
Yeah, you call us direct. My direct line is 907-777-4572. My direct email is mnef@fnbalaska.com. Or call the main line. But we've got a team here that is ready, willing to take your call, answer your questions. And even if there's something about this presentation you wanted to dive a little deeper into, I'd love to get into that with you. But again, just think about it. And if there's anything that we could be doing for you, please let us know.
Thank you very much, Morgan. And thank you to all the attendees who came and joined us today for this presentation and asked very intuitive, interesting questions that help facilitate these discussions. So
now everybody get back outside.
That's right. Beautiful day. So thank you again. And I want to let everyone know that a recording of this webinar will be posted within 24 hours or so on the First National's website. And enjoy the day. Thank you again for attending. Thank you, Morgan.
Thank you.